G'day and welcome to the Investor Motivation Podcast. My name is Rob Goudie, and from Melbourne we've got Ash Rowan joining us, our long-term partner and financial advisor in the business. How are you, Ash?
Good, thanks, Rob. How are you going, mate?
Very well. So you're at the office here. I think we're at 42 degrees in Horsham. Very similar down there, is it? You're sitting there in your shorts and...
Yeah, I mean, a bit of casual today, but we've got a high of 39 here, mate, just checking the watch. Currently 34, high of 39, so still got a bit to go in it.
Right, so it's,
yeah.
And very hot over in the cricket in Adelaide as well, which our bowls are hot as well, which is nice to watch. So today, Ash and I, as we've been doing a few times now, is just putting together some real-life case studies, some interesting stuff that we're seeing as we go through our days and weeks as we're chatting to people, trying to add value and provide a sense of comfort around their money. And that's obviously a big part of what we do. It's not just the numbers and cents, it's how people feel after going through an advice process, Ash. That's probably a feature of the advice you've provided over your years.
Yeah, just to provide that clarity, Rob, I think that's an enjoyable part of our job is to give clients the confidence to proceed down a certain path or a strategy and know what the sort of, what's in front of them in terms of financially and affordability, and when it comes to retirement planning, which is a good one, mate. They get to understand what they can and can't achieve. Very rewarding on all aspects.
Great. Yeah, and it's that sense of comfort and that, people stop stressing about money. Sometimes, we always think about the pensioner people that are on a full age pension, have no other money, might have a house and a car. Those people can be exceedingly happy people, and because there's not much to worry about, but there is responsibility with money, and it comes with a certain amount of stress, and that's where I think getting sound common sense financial advice can obviously reduce the impact of that. And obviously your areas of specialty, Ash, are very much in that aged care and retirement planning, and making sure people are making transition from retirement into aged care facilities, or going from their work life into retirement. And today your case studies are about making that transition.
Yes, so you're right, Rob. I do a lot in the retirement space and obviously aged care, but big changes in someone's life. And the case study I've probably got for us today is I met with a woman through the week who unfortunately went through a separation, and she's in her 60s. And so all the financial responsibilities now fall onto her shoulders, and it's something she hasn't had to deal with in the past. So she's quite afraid to make decisions. And obviously these are big decisions to make because this individual's no longer working, as I mentioned, in her 60s, and we've got to come up with some income solutions that will get us through to pension age, and then qualify and apply to the age pension, and sort of making sure we're structuring her investments and assets in a way that sort of complement one another.
Right.
Yeah.
And as you mentioned that she hasn't made some of these decisions much in the past, is that because her ex-spouse was the primary decision maker and organiser of these things, which is often the case in many couples?
Yeah, that's what's happening in this instance, Rob. So the conversations that we had already is just more about understanding what options this individual has moving forward, just to provide, and a big part, and even today's chat's about providing education and information to listeners, and even all our prospective clients that we have a chat with. It's all about gearing their knowledge up so they're confident to make those decisions. So we had a good chat about, in terms of, the structures that could be set up to support, income strategies through retirement. Currently, her assets are invested into cash, which may have been there since separation, and then just living off the interest, which as we know, the interest rates aren't too exciting, perhaps barely keeping up with inflation, so not too much wiggle room there. So we're just going through the options now with her.
Right, and obviously if it's outside of superannuation in cash, there's a couple of issues that we've got. One is the long-term effect of inflation, and clearly if she's doing some work, or depending on the amount of money that's actually invested, that there can be taxation issues as well.
Yeah, that was a conversation we did have. So income tax could be a real issue for this client, both now and even if retired and receiving the age pension. Not many people understand that the settling age pension is also a taxable income source, but falls beneath it. The maximum age pension for a single individual, let's say, it hovers around the $30,000 mark. When you're retired receiving a government payment, I think we can earn up to about $32,000 around that mark, Rob, before we start paying income tax. So we don't have to earn much interest in our own individual names on top of the age pension before we have to start doing tax returns again. So we've got to be mindful of that.
Right. So you're saying that the age pension, say for a single, is about $31,000. That is taxable income. Any money you get from your other your financial assets is going to go on top of that and taxed accordingly.
That's right. So the strategy, the conversations that we're having is getting money into superannuation while we still can, and for those who don't know, up to age 75 we can make contributions into super, and we do that because the tax environment within superannuation, just in accumulation phase, it's a flat 15%, so we're already very conservative. But for this individual, we'll likely then flick it across to an account-based pension, start to receive an ongoing income distribution that we can support ourselves financially with. But even more importantly, there's a 0% tax rate on our earnings within super in that environment. So that I think is the gold standard. That's where we want to end up.
Yeah, paying, there's no better tax rate than zero. So superannuation is zero all the way up to your transfer balance cap, which for those that are listening and lucky enough to have up to $2 million, that's the amount you can transfer to an account-based pension, which would be 100% tax-free. Now, you mentioned obviously there's going to be payments flowing through that. What payment options do people have? Some people are used to getting paid fortnightly, monthly or weekly. Do you have flexibility about when you get paid your superannuation pensions?
Yeah, we have that conversation with the client, and they're always sort of, we try and fine-tune that strategy to their needs. Some clients are comfortably getting paid monthly, so that's definitely an option, but we can also bring that down to fortnightly if we want. I've got a good handful of clients who like to alternate their super pension payments on the off week to when they get the Centrelink age pension. We know the age pension from Centrelink comes through fortnightly, so on the off week they get their super payment, on the corresponding week they get their the Centrelink payment through. So it's a good way to sort of maintain a budget.
Yep, so weekly in a way. So obviously getting some money into superannuation is part of your strategy to get in that tax-free environment. And I mentioned the other risk, which is inflation. So what's the strategy there?
It is just to increase understanding that we do need exposure to growth assets. And when we say growth assets, it's generally Aussie or international equities or exposure to property there or our growth classes, and complement that with good diversification through to cash and fixed interest. If we're heavily too invested in a conservative nature, we're generating returns around 4, 5, 6% if we're very lucky, and barely keeping up with inflation. So we need to have, we encourage our clients to have exposure to growth assets. Now, they don't have to be 100% high growth or aggressive. In our world, Rob, as you know, we go through an exercise with a client, it's called a risk profile questionnaire, to sort of understand a client's tolerance to market volatility. And at the end of the day, market volatility is always going to be a thing, both good and bad. But we got to understand, well, how does the client react to that, and can they still sleep at night? Then based on that understanding, we sort of have a good idea how much we can expose our clients' funds into that space where we need good growth prospects over a long period of time to support pension payments out of a superannuation fund.
Yeah, and I think you mentioned, let's say this person is mid-60s, a mid-60s lady, there's very high likelihood that that she may be about in 25 years' time at age 90. So it's still long-term, and if you're a long-term investor, it means if you're well educated, and that's a big part of what we do, building up people's knowledge, that if you've got time on your side, you don't need to worry about short-term volatility, and quite often short-term volatility can be opportunity as well. So being more growth orientated will obviously shield people away from the risk, which in my view is the biggest risk that investors have got, is inflation. That 10 years and 20, 30 years later, the purchasing power of your money is gone. It's what I call death by 1,000 cuts. You won't see it over 1, 2 or 3 years, but over decades you will, and it'll be too late.
And with respect to that, Rob, I sort of can flick the switch when we give aged care financial planning, when we might have a lump sum that's not needed for aged care to pay these deposits. It might just be sitting in the cash. Now, at that stage in life, we're not out there investing into growth. We're sort of maximising our safe, return sectors such as cash and fixed interest. So we're looking at those options and really maximising what we can get based on those returns without putting the funds at risk. So different strategies, different times in life.
Yeah, and obviously that is different timelines, and we're talking retirement can be long term from age 60, 65. If someone going to aged care, it's a different kettle of fish.
Different time frame. That's right.
Yes. Yep. Very good. Did you, to help with Centrelink, was there a potential part pension where they were missing out on some extra pension? Will you be looking at any strategies there at all?
Yeah, so this individual will qualify for a part pension. So there's a little bit within cash and superannuation currently. We will look at sort of gifting strategies. Rob, we might look at funeral bonds where we can invest funds up to, I think the threshold here is about 15,000 at the minute, which is fully exempt for Centrelink. I mean, it's still your asset, it's still your investment, it'll still grow in value over the years to come. There's restrictions to when we get access to that. However, we set these up to get a bump up with Centrelink, so we will explore those opportunities. And there's another one to complement income streams in retirement, such as the age pension and super pension. We may look at a lifetime annuity, which means whatever we invest, as long as it's structured accordingly, we could potentially exempt up to 40% of the invested amount from day one.
Yes,
so
and those products will pay out for the rest of her life.
It's a lifetime annuity. So regardless of if this individual will live till age 100 or age 90 or age 80, we will expect the same payment throughout the duration.
Okay. Now, as you mentioned, there's some existing superannuation, and there's obviously, this is a single person, so there's definitely some taxable components from the work days or concessional contributions going in. There's some taxable components, and there's probably some adult children who are not financially dependent. How have you obviously worked around that potential tax that might be there if she was to pass away and still owns the super?
Yeah, so based on this client's very specific situation, so yes, we've got adult children there, so potential death benefit taxes within super. We're looking, number one, there's two funds. Now this could be set up as some form of separation, payout, or whatever it may be. So the first decision here, well, do we consolidate? And there's every chance that we will. Number two, we've got to look at the beneficiaries of the fund. Because the ex-partner may be listed as a beneficiary. It's got to make sure the death benefit nominations are up to scratch, or my client might have an up-to-date will when we can list the legal personal representative for it, so the super can go to the estate. So that's another thing we will explore and tidy up. But based on your question, Rob, if we were to pass away and our superannuation fund is paid to non-financial dependents, so a financial dependent could be our spouse or partner, but if we're single, we don't have that option anymore. Most likely the beneficiaries thereafter will be our children. However, if our children are growing up and no longer financial dependent, like you're referring to, they'll likely pay tax on our superannuation. Now, the tax that's paid, our super is made up in two different components, taxable and a tax-free component. Our beneficiaries, if they're not financial dependent, will pay tax on our taxable component of our super funds at a rate of 17%. So that can be once we work out the components, that could be tens of thousands of dollars. So we will never ignore that for our clients. We're making sure we're reviewing all the options and all the positive strategies that we can implement, but also the risks that may be hiding behind the scenes.
Obviously, a recontribution where you're taking the money out and putting it back in as a non-concessional helps reduce that taxable component.
Yeah, non-concessional contributions, which we can do up to $120,000 each year, forms part of the tax-free component within our funds. So we'll look at all those options. We are limited to how much we can put in at any one time, but we make sure we get those strategies in order to see what will benefit the client.
Yeah, and just so people know that the taxable components is really made up of your employer contributions, your SG, and or your concessional contributions where you've put in a lump sum and you've claimed it as you've got a tax advantage that makes up that taxable side. Now, I'll just wind back a little bit, as you mentioned that obviously from an estate planning point of view, and you mentioned the ex-spouse, the ex-husband, your client passes away, and there's an old saying, where there is a will, there is a relative. Once you've tidied up all the I suppose any potential superannuation death taxes, might you, with the binding death nomination, say there's two children, that you just nominate them half each and keep it away from the estate, just in case there is that chance that the ex-husband comes in and says, I contest, I need money?
Yeah, so superannuation doesn't necessarily need to form part of someone's estate. So if there's a death benefit nomination, if we've got beneficiaries listed on our super funds, our proceeds can be paid out rather quickly and not necessarily need to form part of the estate. Now, if there's a chance where the family are getting along and there's no risk of contestation or minimal risk, we can list our legal personal representative as a beneficiary of our super. Then it'll get paid to the estate. Or if there's no nominations, that's probably where it's likely going to head up. But then we're going to make sure we've got an up-to-date will that really truly reflects our wishes, what we want to happen with our investments and proceeds in the event of death.
Very good. Now, Ash, I'm interested to know, how did you pull all this together for the client to show, that you'll have enough and to know when to spend more and, that the money will last? So was there a pulling together of the advice to say, here is the path, and, based on all the noise, the recommendations, the talk, here is some of the proof?
The conversation evolved, Rob, where this individual was sort of thinking of her children front end to say, okay, well, throughout all the years that she was in a previous relationship, in her mind that the children were going to benefit from maybe the house that they had as part of their own inheritance, and now their financial circumstances have obviously changed considerably. It become a bit of an emotional point to say, okay, well, I want my children to benefit. I always had that goal in mind. Should I be giving them money now? So the conversation evolved from there. And I'd like to bring to her attention to say, okay, well, you still need to financially support yourself both now until pension age, but also once you're on the age pension. As we know, the age pension itself is not a great deal of money. We sort of need potentially something on top of that to live comfortably. And that's what this superannuation would be perfect for, to support and complement the age pension through life expectancy. So based on your question, Rob, we brought out calculators and long-term projectors to say, okay, well, firstly understanding what her expenses or cost of living is and to live comfortably, what it meant to her. And based on that amount, we could then reverse engineer it to say, okay, well, you need this amount as a lump sum. And I use very conservative rates of return when we model for clients. I think I use about 6% return. And that proved that through to life expectancy, which I think for the ladies is around 88. I may be close there, Rob. We try and get through to that point, and it highlighted that there was still going to be half the amount of capital at that point in time. And then there was a suggestion made that, hey, maybe the kids could then inherit that. So you can tick all your objectives off and also live comfortably in the meantime. So it's all about giving that confidence.
Yeah, or spend a little bit more while you're young enough and fit enough to do so.
They're great conversations, Dave. I enjoy those ones.
Yeah, and that's where the doing the projectors are just so important. Yep. Fantastic, Ash. That's a really interesting one, and obviously, big changes in people's lives are often these key moments in time where getting financial advice at a high stress moment where lives have just changed substantially, and that's partly my case study as well, where semi-retired couple, one of them has passed away, and all the income, which was split via family trust to two people, now goes to one person. All of a sudden there is now a substantial tax bill each year, because when you were splitting it, both people were claiming concessional contributions. All that income heads down to one person. And we're looking at a strategy that we haven't looked at for many years, where we haven't had the opportunity. This client actually owns the business premises where he runs his business from. And obviously when the two of them were there, Ash, there was really no need for us to do too much, because we had the concessional contributions, which is a combined $60,000. But this property, we're probably going to put into a self-managed superannuation fund. So this is work that you and I did, Ash, over the last 15 years, where it'd be farming land and put into superannuation, kicking off a lease between the business and the super fund, and potentially getting very large leases that essentially means that reduces the taxable income, goes into the fund at 15%, or if in pension, 0%. So we're looking at that strategy because, again, like your client, my clients had a significant and very sad change to their circumstances and the work, even with just a $20,000 lease, and that's approximately what it is, if they're paying the highest marginal tax rate at 47%, we can have that diverted into superannuation as a lease payment. In pension mode, it won't be 47%, it will be zero. So that is saving nearly $10,000 per year.
Yeah, powerful stuff.
Yeah, so that's, and yeah, while he's still working, that works well, and obviously there's other money, from his existing super fund which will transition in as well. But yeah, there was a little bit of debt here for these clients on their home, so we're going to tidy that up. I'm a firm believer that people in retirement or close to, if they've got the means, don't have the cash in the bank, earning 4% or 3%, pay it off your home loan and save a guaranteed 6%.
Just out of curiosity on that one, Rob, you mentioned the business premises up into superannuation. Now, we're pretty confined to contribution caps. So as you know, for non-concessionals at $120 per year per individual. Yes. How did you manage, or what's the strategy behind getting a big asset into superannuation?
Well, this one, small country town stuff, so it won't be a massive asset. It'll, but let's assume that it's $500,000. Now, it's not that, it's comfortably under. So we have the non-concessional of 120, and then we can use the bring forward rule and put in 360 in one financial year. So if we split the contribution, which you can do part of the property in one financial year and the rest in the next. So you have the ability to put in, so let's think about this financial year itself, that we can put in $120,000 before the end of July, and then we can put in the end of June this year, so this financial year, 25-26, and then in July at any time, because you don't need to meet the work test to put in a non-concessional, $360,000. There is $480,000 that you can get in, and your concessional contributions can also be part of that contribution, which means, over 2 financial years, you can actually put in, let me do the numbers, $540,000 over essentially a 2-month time frames that you've stretched over 2 financial years. So you just got to think reasonably laterally in terms of those contributions.
And if you're a member of a couple still, Rob, I know not in this client situation where we've got a single individual now, but member of a couple, you times that by 2, so 540 each. Yeah.
Yep, these are individual limits that apply to everyone. Obviously, you'd only use the concessional contributions if you're wanting to deliberately reduce tax and your income down to more reasonable levels. So that's one we're working on. We'll cover that off in the new financial year, given that we're one day away from finishing up for the year, and looking forward to 2026.
Perfect.
Fantastic, Ash. All right. I reckon we were always planning on having 2 case studies each, but by the time we ask each other questions and dive a little bit deeper and get distracted as I normally do, I think one each will be enough moving forward. Thanks very much, Ash. Thank you very much for your efforts in 2025. I know you've helped a lot of people. Where can people find you if they want to learn a little bit more about what you do and see some, or even ask you a question on socials?
Easiest way, Google Consortium Private Wealth, Google Ashley Rowan, I think it'll come up now. But on socials, you'll find me on TikTok, Facebook, Instagram. We're pretty avid users of that to try and get good content out there, mate. So you won't have to look too hard to find us.
Very good. Everyone, please feel free to ask us a question by leaving comments here on whatever platform you're watching or listening to us on. Feel free to ask a question or go to our socials, TikTok, Instagram, and so on. We will happily answer any questions that people have, knowing that it is all general advice. Thanks very much, Ash. Thank you very much, everyone, for listening, and we will see you at the next podcast. Cheers.
Thanks, Rob.